Hi everyone and welcome to chapter 10. We are going to discuss about risk and return in capital markets in this recording. So let's start. So in this chapter we'll look at risk and return, then we'll discuss historical risk and return of stocks, the historical trade-off between risk and return, common versus independent risk, diversification in stock portfolios. So learning objectives that we are going to cover: identify which type of securities have historically had the highest return and which have been most volatile, compute the average return and volatility of returns from a set of historical asset prices, understand the trade-off between risk and return for large portfolios versus individual stocks. Then we'll describe the difference between common and independent risk and explain how diversified portfolios remove independent risk, leaving common risk as the only risk requiring a premium. So let's start. So consider how an investment would have grown if you would have invested in the following. And they're looking at data from 1956 to 2014. So S&P 500, then TSX Composite, S&P 500, long-term Canadian bonds, and long-term means Government of Canada Treasury bills. So I'll explain each one of them. So TSX Composite means it almost covers 90 to 95% of all companies that are listed in Canada, right? So it has around 258 companies having some $1 trillion worth of market cap. So it's a broad stock market index for Canadian stocks. S&P 500 is 500 top companies in United States. So these 500 companies come from different sectors. So some are from tech, some are from let's say pharma, some are from manufacturing, some are from auto, right? So it's top 500 companies across different sectors. Long-term Canadian bonds are 10-year plus Canadian bonds that you can invest in. Government of Canada T-bills is short-term debt, so it is generally issued like with a duration of less than a year, so you have to roll it over, so each year you keep on investing. Okay, so which would have the highest return? So if you go, we'll look at it. So at least the first two parts we can look at it. So I'll open an Excel. And I'll also open Yahoo Finance. Okay. So let's look at TSX 60. And let's go to max. So it has data from 79, it doesn't have data from 56. So let's calculate from 1st of June 1979 to today. So 79 to 2020. So the time period we are looking at for TSX is 1979 to 2020. So in 1979 this index was at 1695 and in 2020 this index has been at 16282. Okay, so how much has it grown? So how to find it out? Final value divided by initial investment minus 1. So it has grown 8.60 times. So if you had invested $10,000, that would be right now $86,000 in TSX Composite. which is a broad market index for Canada. So if you did the same thing in S&P 500, so we can go back to the home page, click on S&P 500, go to max, okay. Now this gives data from, so let's make it comparable. So we are looking from 79 to 79. So 79 it was 106. Okay, 79 it was 106. Right now it is 3509. So how much it has grown by? 32 times. So $10,000 if you invested in 1979, that would be $321,000 today. $321,000 today. So it's a big difference between TSX 60 and S&P 500. Now what is the difference between these two? So Canadian sector is mostly natural resources. So most of the companies that are listed are natural resources plus financials, right? United States is mostly tech plus like manufacturing plus auto, everything. So all the major companies in the world are listed at United States. So that's because of that there is a massive difference between returns. So your money has become 8 times from 1979 to 2020 with 2 recessions, right? 2 major recessions, 2000. So actually there were a lot of recessions. 1980 was a recession, right? Then 2000 was a recession, dot-com bubble burst. Then 2008 was a recession, and 2020 initial part was a recession because of a big market drop. So all these market drops, even if you factor that in, money becomes 8 times in Canada from 1979 to 2020, and money has gone almost 32 times in United States in the same duration. Okay, so how do you can you calculate average returns? So how do you calculate average returns? So average returns can be calculated by finding the number of years first. So 2020 minus 1979, 41 years. So your money has become 8 times, right? Divided by 41. So I have to subtract 1 before that. Okay. So this, yeah, I've already done that. So this, okay, and average in this will be you cannot find it this way. So annual returns can be found using rate function. So I'll show you how to do it. Equals to rate. Okay, we are finding out rates. Number of years is 41 years. Okay, payments are 0. You invested, let's say $10,000. It became $86,000. Right, 86 grand, right? So what is the rate of return? Signs are important. So whatever you invest is negative, whatever you get is positive. So rate of return of Canadian market has only been 5.39%. So annual appreciation, average appreciation. Now rate of return for American markets for the same time period, 41 years, present value 10 grand, future value this much. So rate of return has been 8.82%. So there is a significant difference between returns in Canadian markets and American markets. Okay. So maximum wealth, right? Even if you consider till 2020, maximum wealth could be created from S&P 500 rather than TSX Composite, right? S&P 500 is riskier too. TSX Composite is has much lower volatility, but S&P 500 has much higher volatility. Okay. Now, how do you calculate realized returns? We have discussed this. So realized returns on any stock is the dividend that you receive and capital gains that you receive. So I'll write down the formula. Okay. So realized returns from a stock equals to dividend yield plus capital gains. Now what is dividend yield? It is dividend received divided by amount invested. What is capital gains? Capital gains is current value divided by amount invested minus 1. So realized returns from a stock is dividend yield plus capital gains. How do you find dividend yield? Dividend received from the stock divided by amount invested. How do you find capital gains? Current value divided by amount invested minus 1. Okay, add them up. That is the realized total return from a stock. So we'll do this example. Barrick Gold paid a dividend of 0.03, right? Reports a dividend in Canadian dollars. It is listed in TSX instead of NYSE. You bought Barrick Gold stock for $21 and you sold it immediately after dividend was paid for $25. What is the realized return? So let's put some numbers in. So dividend received is 0.03. Okay. Amount you bought it at, amount invested is $21, 21.49, and current value or the value that you sold it at is 25.59. Okay, 25.59. So what is the realized returns? How do we find it out? First, let's find out dividend yield. Dividend yield is dividend received divided by amount invested. Okay, then find out capital gains. Current value divided by invested value minus 1. Okay, and add them up. So this plus this. So returns that you would realize is 19.218%. So they have calculated. So they calculated dividend yield, they calculated capital gains, they have added it up. That gives you total returns, total realized returns from a stock. Okay. Then computing historical returns, individual investments. So for a quarterly returns, 4 compounding period that make up a year, the annual realized returns is compounded by finding out these things. So let's do it on my portfolio. I'll explain to you how it will work. So let's but it will take time, so I'll just make up data and then I'll explain you. Okay, so what is annualized return? So annualized returns means you can convert any form of returns to annualized returns. So let's say you are given monthly returns. Okay. So these are 12 months monthly return, 1%, then 2%, 3%, 4%, minus 5%, minus 6%, 10%, 11%, 3%, 2%, and 1%, and one more. So let's say 2%, last one. So these are this is what returns are given to you based on different months. So first month it was 1%, second month it was 2%, 3%, 4%, minus 5%, minus 6%, so on and so forth. So these are monthly returns. So how do you find the annual return? So annual return can be found out by using this formula. 1 plus annual return equals to 1 plus corresponding monthly returns, quarterly returns, or whatever is given. So let's say monthly returns we are finding out. So how to do that? So the formula is 1 plus the first month return, so 1%, multiplied by 1 plus second month's return, 2%, multiplied by 1 plus third month's return, 3%. Same way fourth month's return, fifth month's returns. Now this is tricky. So fifth month it is minus 5. So plus and minus becomes minus. So it is 1 minus 5%. Okay, multiplied by 1 minus 6%, because the returns are negative. So you have to subtract. The rest of it is clear cut. So 1 plus 10%, 1 plus 11%, 1 plus 3%, 1 plus 2%, 1 plus 1%, finally 1 plus 2%. So you multiply everything, right, first, so whatever is the result, and you subtract 1 from it. So that is your annual return for the given period. That is your annual return for the given period. Why do you subtract 1? Because you are adding 1 everywhere. That's why you have to subtract 1. Because if in this formula, if you want to find annual returns, this 1 that is added, right, goes here, which becomes subtraction after solving this bracket. So 1 plus monthly, quarterly, whatever period is given. So 1 plus that period into 1 plus next period, 1 plus next period, so on and so forth. So suppose you purchased Barrick Gold on December 2016 and held it for a 1 year, selling on January 2. What was the realized return in 2018? Okay, so we have already done this. So we did it in Excel in the last example. So we need to analyze the cash flows from holding ABC stock for each quarter. In order to obtain cash flows, we must look at ABC stock price at the start and end of the year and any dividend dates. From the data, we can construct the following table to fill out the cash flows. So these are the cash flows that are given for ABC stock. Okay, compute the returns between each set, then determine annual returns in the similar way. Okay, by compounding. Okay, so let's solve this so that you'll understand more. So I'll copy this, we'll take it to Excel and compute returns first, then compute annual returns. Okay, so dividends are given, then returns are given to you. So this is the return that the stock has given. Okay, not this one, we need this one so that we compute it. Yeah, this is what we needed. We have prices, we have dividends, we have to calculate realized return. So how to do that? We calculate dividend yield. Okay, and we calculate capital gains and we add them up to get realized returns. So how to do that? Dividend yield, first period everything is 0, you just invested. Second period it is dividend divided by amount invested, always dividend divided by amount invested. So dividend yield each period will be dividend divided by amount invested, the initial amount you put in, not the current market price. Okay, capital gains will be this. So current year's value divided by previous year's value minus 1. Then current year's value divided by previous year's value minus 1. Then current year's value divided by previous year's value minus 1. Previous period's value. Current year divided by previous year minus 1. And finally current year divided by previous year minus 1. Okay, so let's look it in percentage. So we know dividend yield, we know capital gains, realized return is addition of these two. If you just drag it, these would be realized return. So once again, how to find it out? Dividend yield is always dividend received divided by amount invested. Okay, for you. Then capital gain is for every period. Let's say for this period it is current year's value, current period's value divided by previous period's value minus 1. Okay, so we found out capital gains and realized return is addition of these two. Okay, now we have realized returns. So can we find out annual returns from this? So the total period is December to Jan. Like, so we know how to find out annualized returns. So it is always equals to 1 plus 0% multiplied by 1 plus 19.22% multiplied by 1 plus 13 into 1 plus 1.05 into 1 plus 18 into 1 plus 5.32. Okay, this is step 1. So multiply everything, right? So 1 plus given period returns, right? And multiply everything. Next step, whatever is the answer, subtract 1 from it. So the holding period return for the period that you have hold the stock is negative 11.02%. Negative 11.02%. Okay. So they have done that, like they've calculated for each period. Okay, returns, dividends, the overall return was negative 11%. Overall return was negative 11%. So they've shown the calculations. By repeating these steps, we have actually computed the realized returns for holding stock over this period. Okay, so this stock has lost 11% value in a given year. Now next, how to find out annual returns. So annual is add returns from each of these periods and divided by time period. Okay, now next is important. We are going to discuss variance, standard deviation, and then we'll try to calculate it on this data. Okay, so first I'll explain it. Now conceptually, what is variance and standard deviation? So variance and standard deviations are risk measures. They are risk measures. Both of them measure total risk. Both of them measure total risk of any instrument that you are analyzing. Okay. Now, what are risks? What do we mean by risk measures? Risk measure means they calculate deviation from the mean. They calculate deviation from the mean. So how much the stock or the asset deviates from mean. Okay. So I'll show you calculation of variance and standard deviation, and we'll compare two stocks. So let's say stock A had these return profiles in the last 5 years. So first year it gave, so this is returns, annual returns. Okay, so annual returns was 12%, 11%, 13%, 9%, and 10%. These were annual returns of stock A. Let's say stock B had these annual returns. So 40%, minus 20%, 13%, 3%, and plus let's say 35%. These were annual returns from stock B. Now you have to find out which stock has more risk involved. On the face of it, stock A appears to be much stable. It is 11, 12, 9, etc. Stock B appears to be much more volatile. But can we measure these? Can we definitely say that stock A is less risky than stock B? So yes, we can do that. So how to do it? So we have to calculate standard deviations for these two stocks. So first I'll do it for stock A, then we'll repeat the process for stock B. So steps for calculating variance and standard deviation. Step 1, calculate the mean. How do you calculate the mean? Mean is nothing but average. So add all these returns. Okay, divided by period. So 5 years, right? So returns, I have added everything and I have divided by 5. That is your mean. Okay. So this was step 1. Step 2, find out difference from the mean. So returns minus mean. Returns minus mean. Returns minus mean. Okay, I'm making it constant so that I can drag it down. What was step 2? Returns minus mean. That is deviations. We are calculating deviations. Step 3, we square them up. Okay, because we are interested in how much deviations are there. We are not interested whether they are positive or negative. So to remove this sign, we square them up. Okay, how to square them up? So this to the power 2. Okay, so each of this to the power 2, this to the power 2, this to the power 2, this to the power 2. So we square the deviations. That was step 3. Step 4, we add those deviations up. We add those deviations up. Okay. So step 4, we added those deviations up. Step 5, we divide those deviations, right, whatever added deviations were there, by n minus 1. So I'll write down these steps before we do that. So this was square, this was add everything up, this is divide by n minus 1. So this divided by n minus 1. So n is 5, number of years is 5 minus 1. Now why are we dividing by n minus 1 and not n? The reason is when we look at stocks, we generally look at sample. So the stock may be listed from, if you're looking at the total data set. So since the time the stock was listed till today, you will divide it by n. But if you're looking only at a sample data set, right, sample time period, then you will divide by n minus 1. That is a samples variance, right? This is variance. So we calculated variance. The next step is to calculate standard deviation. So how to calculate standard deviation? It is square root, SQRT, square root of variance. And this is very meaningful. We look at standard deviations because it's an important figure. What does it show? It shows that this stock has a risk of 1.58%. This stock has a risk of 1.58%. Also, one other way to look at it, right? This is based on normal distribution. The concept that I'm going to discuss is based on normal distribution, which says that if the stocks behave normally, 95% of times, 95% probability, the stock will be between plus or minus 2 standard deviations. So it will not take it, plus or minus 2 standard deviation from mean. It means that 95% of the time the stock will be between lower limit and higher limit. Lower limit is mean, okay, mean minus standard deviation, and mean plus standard deviation. What does it mean? That 95% of the time the returns from the stock, annual returns from the stock, will be between 9.4% to 12%. 9.4% to 12%. Okay. So these are the steps, and this is standard deviation. So how to do it? Once again, step 1, calculate the mean. Step 2, calculate this deviations, difference between returns and mean. Step 3, square them up. Step 4, add everything up. Step 5, divide it by n minus 1, and that is variance. Then take the square root, that is standard deviation. Take a square root of variance, that is standard deviation. Standard deviation is also called as total risk. So this is the total risk from the stock. So it will deviate on an average 1.58%. And normal distribution rule says 95% probability that it will stay plus or minus 2 standard deviations from the mean. Okay, so let's do that for stock B. So annual returns are given, time period is given. So let's follow steps again. Step 1 was calculating mean. So mean is add everything up, divide by n. So 40 plus 20 plus 13 plus 3 plus 35% divided by 5. So this is the mean. Mean is much higher. Okay. Second, deviations. How to calculate deviations? Returns minus mean. Okay. I'll make mean constant so that I can drag it. So this was step 2. We squared it. Step 3, sorry, we calculated deviations, not squared. Step 3, we will square it. So whatever you have got to the power 2, that is how you square it. So these are squared deviations. Step 4, add them up. Okay. Step 5, take, divide by n minus 1. So this divided by n minus 1, so 5 minus 1. This is your variance. And then we calculate standard deviation. So standard deviation is this square root of that. So XQRT square root of variance. So this stock has a risk of 24%, which is way higher than 1.58%. Okay, and our 95% probability rule says this stock 95% of the time will be between, so annual returns will be between 14 minus 24 and 14 plus 24. So the range is much wider. So the annual returns can fluctuate with 95% probability between minus 10% to 38%, and annual returns here can fluctuate between 9.4% to 12%. So this stock is much more stable. Okay, so let's cover the concept. Variance, it's a method to measure the volatility of returns. It is the expected squared deviation of returns from the mean. So formula is 1 divided by n minus 1 and squared deviations, addition of squared deviations. We do it in Excel, which is much more easier. Standard deviation, it's a risk measure in which we take square root of variance, So they have taken this example 2018, 2019, 2010, 2011, 25, same thing, 5 years returns, right? Oh, they have taken more returns. So 2008 to 2017 they have given the returns. You have to calculate standard deviation. So find out the mean, right? Take the difference, square it up, right? And I'll give this example for you to do in Excel. So follow our approach, follow the method that we followed, and try this example out. Okay, so it should look something like this. Returns are this, mean was this one, difference is this, we square it up, right? We add all those squared deviations, divide by n minus 1, n was 10 minus 1, 9, okay, and we take square root of it to find standard deviation. So standard deviation, the answer should be almost 18.94%. Our best estimate of the return of SAP 500 index return is, but the risk is much higher, 18.94. Then we discuss the normal distribution 95% confidence interval rule, which says that average plus or minus 2 standard deviation covers 95% probability. About 2/3 of all possible outcomes will fall within 1 standard deviation or below. So we found out the average return of TSX SAP composite index from 2008 to 2017 was 6.35% with a standard deviation of 18.94. With 95% standard confidence interval, what would be return for 2018? So how to find it out? So lower limit and upper limit. Lower limit is mean minus standard deviation. Upper limit is mean plus standard deviation. Okay, so mean minus standard deviation and mean plus 2 standard deviations. Did we do 2? No, we did not. So it should be 2 standard deviation. So 2 multiplied by. So one change, you have to do 2 into this. So range is 7% to 14%, and here it will be 2 into lower limit and 2 into upper limit. So range is minus 34 to 63%. 95% of the time it will fall under this. 95% of the time it will fall between lower and upper limit. Okay, so 6.35% minus 2 into standard deviation lower limit, 6.35% plus 2 into standard deviation upper limit. So even though average returns from 2008 to 2017 was 6.35%, the TSX composite was much more volatile. So if we want 95% confidence of 2018 returns, the best we can say, it will lie in the range of minus 31% to 44%. Now, historical trade-off between risk and return. The returns of large portfolios, the investment with higher volatility as measured by standard deviations, tend to have higher average returns. So larger stocks have lower volatility. Even the large stocks are typically more volatile than portfolio of large stocks. The standard deviation of an individual security doesn't explain the size of average returns. All individual stocks have lower returns than portfolio. So what does it say? That in terms of risk, small stocks will be the most risky, followed by large stocks, and then followed by stock portfolios, that is combinations. In terms of total risk, most risky are small stocks, then individual large stocks, then stock portfolio. So when you create a portfolio, when you add 2 or more stocks, the risk generally goes down tremendous. Okay, this is important. So any stock investment that you do has 2 types of risk: systematic risk okay, systematic risk means overall market risk, and non-systematic or unsystematic risk, whatever you call it, which is stock specific risk. Now example, overall market risk will be interest rate risk, or it could be a pandemic. Pandemic will impact all stocks. It did impact all stocks, okay, initially when it came. So interest rates, pandemic, wars, famines, like that impacts everything. That is overall market risk. Stock specific risk will be strikes at Ford Motors. So if people are striking at Ford Motors, it will impact Ford stock. It will not impact the overall market. So there is non-systematic risk and there is systematic risk. Systematic risk impacts overall markets. Non-systematic risk are stock specific risks that impact only specific stock. Now why is it important? Now this systematic risk cannot be diversified. Okay, non-systematic risk can be diversified. Now what do we mean by diversification? Diversification means if you invest in more and more stocks, like let's say I have a one stock portfolio, I have just Apple in my portfolio, then if something bad happens to Apple, all my portfolio will go under losses. But if I don't put all my eggs in one basket, if I divide my investments, so I have Apple, I have Facebook, I have, let's say, JP Morgan, I have Citibank, I have RBC, I have, let's say, Suncor, right? So my risk is divided. So if one company performs bad, it doesn't impact every other investment that I have. So stock specific risk can be diversified. So if you have 2 or more stocks in your portfolio, you can reduce stock specific risk. But systematic risk, the risk that impacts everything, cannot be diversified. Okay. So types of risk: common risk, risk that is linked across outcomes; independent risk, risk that bears no relation to other risk. If risks are independent, then knowing the outcome of one provides no information about other. Diversification, the averaging of independent risk in a large portfolio. So they have given an example. You are paying a very simple game, $1 bet, that is each bet you get $1 and flip a coin, right? Heads you win, tails you lose, right? There are two possible ways to play it. One possibility is you put $1 at stake and play 100 times, or you put $100 at stake and play only one time. Now which is more riskier, putting $1 at stake or putting $100 at stake? So $100 at stake is much more riskier because chances of going wrong increases. So if you relate it to stocks, putting all your money in one stock is way more riskier than dividing your money in 100 different stocks. Okay, then they've calculated that, so not very important. This is important. Unsystematic versus systematic risk. Stock prices are impacted by two types of news: company or industry specific news, that is called as unsystematic risk, and market wide news, that is systematic risk. Unsystematic risk are fluctuations of stock returns that are due to company or industry specific news and are independent risk unrelated across stock. Systematic risk, fluctuations of stock returns that are due to market wide, representing common risk. So which risk can be diversified? So systematic risk cannot be diversified because that risk impacts everything. Unsystematic risk, stock specific risk, can be diversified. So investors are not compensated for holding unsystematic risk. So if you're just investing in Apple, you will not be compensated for taking more risk. Importance of systematic risk: the risk premium of a security is determined by its systematic risk and does not depend on diversifiable risk. There is no relationship between volatility and average returns for individual securities. So what was the bottom line? It is always a good idea to diversify.